On January 29th, Freddie Mac published a number that looks small and behaves like a wrecking ball. The average 30-year fixed mortgage rate prints at 6.10%. That single line sits on top of an interest rate chain that begins in the U.S. Treasury market, a market now measured in the tens of trillions. When that chain tightens, housing affordability is not hurt, it is mathematically reduced. And in the same month, the Treasury market flashes a second signal. On January 12, 2026, the U.S. government auctions $39,009,000 of 10-year notes, and the high yield clears at 4.173%. This is what a liquidity squeeze looks like in real time. Not as a crash on a chart, but as a higher discount rate on the asset every middle-class family borrows to buy. Now place one more fact on the table. BlackRock manages roughly $14 trillion in assets by the end of 2025. At that scale, a 2 percentage point shift away from long-duration treasuries is not a rotation. It is roughly $280 billion of exposure forced to find a new home. So when the headline says BlackRock sold $250 billion in treasuries, the number is not the point. The mechanism is. Because when duration is pushed out of the system, Treasury yields rise, mortgage rates follow, and the cost of shelter reprices upward for everyone. And if you carry a mortgage, plan to buy a home, or fund retirement through rate-sensitive markets, this changes everything. What if everything you believed about safe liquidity in treasuries was wrong? The pattern does not begin with panic, it begins with convenience. In normal times, treasuries function as collateral, as savings, and as a pricing anchor. Credit is abundant, money is cheap, and the system is rewarded for stretching duration. Then the cycle turns, not because people become irrational, but because the plumbing runs out of room. This unfolds in 4 stages. Stage 1 is liquidity expansion. Central banks suppress volatility, balance sheets grow, and the market learns to finance everything. Stage 2 is duration stretch. Investors reach for yield, portfolios add interest rate risk, and safe bonds stop behaving like ballast. Stage 3 is collateral drain. The demand for high-quality collateral rises, while the available pool becomes trapped in regulations, balance sheets, and trade hedges. Stage 4 is credit repricing. Funding costs rise, spreads widen, and the real economy feels it through mortgages, business loans, and layoffs. Throughout the last 100 years, every monetary system built on leverage and confidence follows the same sequence. The timeline varies, but the order does not. Liquidity expands, duration stretches, collateral drains, and credit is repriced. This isn't prediction. This is pattern recognition from a century of market behavior, repeated across empires, currencies, and banking regimes. The reason it repeats is simple. Debt systems are not powered by belief. They are powered by collateral and cash flow. When collateral becomes scarce, the system does not negotiate. It tightens. And tightening always shows up in the same place first. Sovereign debt yields, then mortgage rates, then the household balance sheet. That is the framework. Now watch it move through history. In 1914, the British Empire controls the world's financial bloodstream through sterling and the gold standard. Then stage 1 arrives in wartime form. Credit expands to fund survival, and the state borrows at a scale the old system cannot comfortably absorb. By 1918, Britain's debt load has exploded relative to its pre-war economy, and gold convertibility has already been suspended under wartime pressure. Stage 2 follows with a familiar temptation. In 1925, Britain returns to the gold standard at the pre-war parity. That single decision becomes a duration bet on the nation itself. It implies the currency is strong enough, wages flexible enough, and exports competitive enough to carry the cost. The data shows the stress building through the late 1920s. Deflationary pressure squeezes industry, unemployment remains elevated, and the central bank defends parity by tightening domestic conditions. This is the moment where safe policy becomes a trap. The system chooses credibility over flexibility. Then stage 3 hits. Collateral drains, gold flows outward, and the defense becomes impossible to maintain without breaking the economy. In September 1931, Britain abandons the gold standard. That event is often described as a currency story. It is also a liquidity story. A sovereign promise was being priced by a fixed constraint. And once that constraint became incompatible with domestic stability, the price mechanism won. The same pattern, same stages, same outcome. Liquidity expansion funded the shock. Duration stretch locked in the assumption. Collateral drain revealed the constraint. And credit repricing followed, spreading through banks, trade, and households. The empire did not collapse in a day. The financing conditions changed first. And once financing conditions change, everything built on cheap credit becomes vulnerable. That vulnerability is the bridge to the modern world. The second case study is not an empire. It is a currency regime. In 1944, Bretton Woods establishes the US dollar as the central settlement asset, convertible to gold at $35 per ounce. Stage 1 is global liquidity expansion under a new architecture. Dollars flow outward to rebuild trade and industry. Stage 2 is duration stretch, disguised as confidence. Foreign central banks accumulate dollars, and the system assumes convertibility as more than a promise. By the late 1960s, the constraint becomes visible. The U.S. runs persistent deficits, and the quantity of external dollar claims dwarfs the gold stock meant to back them. This is collateral drain in monetary form. The world wants the anchor, but the anchor is finite. On August 15, 1971, the convertibility link is severed. That decision is often framed as politics. In this framework, it is Stage 3 concluding exactly as it always does. The constraint breaks because the system cannot carry it. Then Stage 4 arrives in the only way it can. Credit reprices through inflation. By the early 1980s, U.S. policy rates are driven to extreme levels to restore credibility, and the cost of borrowing punishes every rate-sensitive asset. The timeline varied, but the sequence never changed. Expansion created scale. Duration stretch embedded the assumption. Collateral drain revealed the limit. And credit repricing forced the reset. Notice the constant. The repricing does not begin with stocks. It begins with the benchmark cost of money. That benchmark today is the Treasury yield curve. And the Treasury curve is now the global collateral spine for derivatives, repos, mortgages, and bank balance sheets. So when Treasuries are pressured, the system is not nervous, it is losing lubrication. Now the third case study shows how fast that loss can travel. In September 2008, a modern liquidity machine seizes. Lehman fails on September 15, 2008, and the financial system discovers that solvency and liquidity are not separate problems. They are the same problem at different speeds. Stage 1 has already occurred in the years before. Credit expands through securitization, leverage rises, and risk is priced as if volatility has been defeated. Stage 2 follows with duration and complexity. Mortgages are pooled, rated, sliced, and financed as if housing cannot fall everywhere at once. Then Stage 3 arrives as collateral drain. Haircuts rise, repo funding tightens, and instruments that were treated as cash are no longer accepted at full value. Stage 4 hits with surgical cruelty. Credit reprices in days. The response becomes historic in scale. The U.S. authorizes hundreds of billions in emergency support through facilities and guarantees. Over the following years, central bank balance sheets swell as asset purchases replace broken private market demand. The lesson is not that intervention exists. The lesson is what intervention is trying to replace. It is trying to replace lost collateral velocity. Because in a leveraged system, what matters is not only what you own, it is what you can finance. That truth returns again in September 2019, when overnight funding rates spike and the system learns, briefly, that reserves and collateral distribution can fracture even without a recession. And it returns again in March 2020, when the global dash for cash forces even treasuries to behave like risk assets until backstops restore market function. 3 systems, over a century of history, the identical 4-stage cycle. Liquidity expands, duration stretches, collateral drains, credit reprices. The only question is where we are now. Right now, today, as of February 2, 2026, The 10-year Treasury yield sits around the low 4% range, and markets are trading every basis point like it matters. It matters because mortgages are priced off this curve, plus a spread that widens when liquidity deteriorates. Freddie Mac's survey prints the 30-year fixed rate at 6.10% as of January 29, 2026. That is not simply higher borrowing. That is a monthly payment increase measured in hundreds of dollars for the same house, and a lifetime cost measured in tens of thousands. Now place Treasury issuance pressure beside it. On January 12, 2026, the Treasury sells $39,009,000 of 10-year notes, and the clearing yield is 4.173%. When auctions must clear at higher yields, it is the market demanding compensation for duration and for uncertainty. Now add the institutional flows that decide whether yields stabilize or surge. BlackRock manages roughly $14 trillion in assets by the end of 2025, and its iShares platform produces hundreds of billions of dollars in annual flows. At that scale, reallocations that look small in percentage terms become enormous in dollar terms. And the plumbing amplifies them. Bond ETFs do not politely reduce exposure. Redemptions force authorized participants to deliver bonds, and delivery becomes selling pressure exactly when liquidity is already thin. This is the hidden crisis in the title. The crisis is not a single trade. It is the system's dependence on smooth collateral exchange. Now look at money market behavior, the purest real-time liquidity signal. In the week ending January 21, 2026, money market funds see roughly $34.93 billion in net outflows. When cash vehicles shrink, it means the system is pulling liquidity out of the safest parking lots. Meanwhile, the Federal Reserve still sits on a balance sheet measured in the high single-digit trillions, a legacy of the last cycle's interventions. A large balance sheet is not neutral. It changes market structure, dealer inventory behavior, and the distribution of collateral. And geopolitical shocks do not stay in headlines. Dollar volatility has already been described as seeping into the Treasury market, pushing longer yields higher before stabilizing. That is the transmission mechanism. Currency expectations shift foreign demand. Foreign demand shifts Treasury prices. Treasury prices shift mortgage rates. Some will say this time is different. The data shows why it isn't. The system is still built on the same foundations: sovereign debt as collateral, leveraged intermediaries as distributors, and households as the final absorber of higher rates. If you are in your 20s or 30s and trying to buy a first home, this affects you because each move in long rates is not abstract. It is the difference between qualifying and being priced out. If you are in your 40s or 50s and carrying a mortgage reset, it affects you because refinancing becomes impossible at scale when spreads widen. If you are retired or close to retirement, it affects you because portfolios that require stable bond pricing to dampen volatility can fail when bonds and risk assets fall together. The pattern confirms where we are. Stage 1 already occurred through years of liquidity support. Stage 2 is visible in duration behavior and in the assumption that bonds always stabilize a portfolio. Stage 3 is now the battlefield, collateral and funding, and the repricing phase begins the moment the market decides liquidity is no longer free. The next 12 to 24 months do not require fantasy to describe. The cycle provides the map. The first warning sign is persistent upward pressure in long-dated Treasury yields, even when policy rates pause or fall. When that happens, it signals that the market is demanding a term premium for holding duration, not merely reacting to central bank policy. The second warning sign is widening spreads between mortgage-backed securities and treasuries. That widening is a liquidity tax. It is the market charging extra for the risk that buyers disappear when they are needed most. The third warning sign is stress in short-term funding, measured by sudden spikes in repo rates, rising haircuts, or repeated episodes where cash instruments trade with unusual volatility. This isn't fear. This is preparation based on historical precedent. In every case study, the repricing phase did not begin with headlines. It began with plumbing. And when plumbing tightens, policy responses tend to arrive after the household has already absorbed the shock. In practical terms, the next 12 to 24 months are likely to be defined by a fight over duration and over collateral. If institutional portfolios continue to reduce long-duration exposure, yields can rise even without an economic boom, because supply must be absorbed at a higher price of money. If Treasury issuance remains heavy, auctions must clear at yields that attract real buyers, not just leveraged intermediaries. And if volatility rises, the demand for pristine collateral increases, draining it from secondary markets and intensifying the squeeze. For retirement accounts, the implication is not that bonds become worthless. The implication is that the path of returns becomes uneven, and diversification assumptions can fail at the wrong moment. For savings, the implication is not to panic. The implication is to treat liquidity as a resource, not as a background condition. When liquidity is scarce, the system pays the prepared. And preparation is not a product, it is a posture. Lower forced selling risk, fewer rate-sensitive obligations, and a clear understanding of where cash flow comes from. The mistake is to assume the next squeeze will announce itself in advance. History proves it does not. The thesis is simple. When large institutions reduce long-duration Treasury exposure, whether through reallocations, redemptions, or risk controls, the Treasury market must clear at higher yields. Higher Treasury yields, plus wider liquidity spreads, translate into higher mortgage rates and a slower, more expensive housing market. You have a choice. Understand the pattern and position accordingly, or ignore it and hope this time is different. This is not about predicting a date for collapse. It is about recognizing the sequence that always appears before credit is repriced. Liquidity expands, duration stretches, collateral drains, and the real economy pays the bill through borrowing costs. But remember, this time is never different. The pattern is absolute. If this analysis opened your eyes, subscribe now. In my next video, I'll show you the 3 indicators that historically peak right before the squeeze moves from Treasuries into corporate credit. The liquidity shift is coming. The only question is whether you'll see it before it arrives.